You know, the monthly payment. You say it like it's the price of the house. We're paying $2,200 a month. That's the number you tell people. That's the number on the budget. That's the number you qualified for. That the lender confirmed, that the real estate agent nodded at $2,200 a month. What you probably don't say, what most people never say, because most people have never sat with it long enough to feel its full weight, is the total, the actual, complete, final number you will pay for the house you're living in right now. Because that number is not the price on the listing, not even close. Think about the day you closed. You sat at a table with a stack of documents thicker than anything you've signed before or since. Someone handed you papers at a pace designed to keep the process moving rather than the understanding deep. You initialed pages you didn't fully read because the room had a particular energy professional. Forward-moving, final, and the moment did not invite the kind of slow, careful scrutiny the transaction actually deserved. You signed for the house, and somewhere in those pages, without anyone reading it aloud, was the amortization schedule. The document that shows, month by month, exactly how every payment you make for the next 30 years gets divided between the bank and the asset you're trying to own. Most people have never seen their amortization schedule. Most people don't know they can ask for one. Most people don't know what it would do to them if they did. Here is what it would show you on a typical 30-year mortgage at a rate that would not have surprised anyone in the last several years. In your first payment of $2,200, roughly $1,700 of it goes to the bank as interest. Maybe more. Perhaps $200 goes toward the principal, the actual balance, the thing you own. The rest is taxes and insurance escrow. You paid $2,200 for your home this month. You own approximately $200 more of it than you did last month. And what happens next is the part most people never see. Month after month, that ratio shifts, but it shifts slowly. In the first year, across 12 payments, you will have sent roughly $26,000 toward your mortgage. You will have reduced your principal by perhaps $3,000. The remaining $23,000 went to the bank as profit on the loan. That is not a complaint. That is a description of how the math works. The bank lent you money. They charge interest on what you owe. What you owe is very high at the start and declines slowly, so the interest calculated on the outstanding balance is highest at the beginning when the balance is largest. This is called amortization. It is the standard structure of every long-term loan. It is not hidden. It is not illegal. It is not a conspiracy. It is simply a structure that takes approximately 12 to 14 years before you are paying more principal than interest in a given month. It is a structure in which, if you stay in the house for 30 years and never pay extra, you will pay the bank between 1.5 and 2 times the original purchase price when you add up all the interest. It is a structure in which the bank's return on the loan is front-loaded and your equity build is back-loaded. And the conventional 30-year timeline was not designed around your fastest path to ownership, it was designed around the longest sustainable repayment term that a typical borrower could qualify for. Nobody told you to read it this way. You were handed a monthly payment and a dream. The dream was real. The monthly payment was also real. The full cost was in the fine print that nobody read aloud. You were too busy making the biggest financial decision of your life to be given the time to understand its actual structure. Let me tell you about a couple named James and Renata. They bought their house in 2009 for $310,000. 30-year mortgage at 5.8%, monthly payment, principal and interest was about $1,820. They were careful people, they paid on time, every month, for 11 years, they paid faithfully. They never missed a payment. In 2020, a job change prompted them to check their payoff balance before deciding whether to sell. They had paid $1,820 a month for 132 months. That's $240,240 out of pocket, not counting taxes and insurance. Their remaining balance, $197,000. They had paid nearly $250,000 and still owed more than they originally borrowed after subtracting the down payment. They owned less than 40% of a house they'd been paying for over a decade. They were not devastated by this. The house had appreciated. Their equity was real. But when James looked at how much of those 11 years of payments had gone to interest versus principal, the numbers sat with him in a way he didn't expect. He told me later, "I thought I was buying a house. For 11 years, I was mostly renting money." That sentence is the whole lesson. But here's what nobody tells you about the 30-year mortgage And this is where the real conversation starts. The 30-year term was not always the default. It became the dominant product in the American mortgage market through a specific set of policy decisions in the mid-20th century designed to make homeownership accessible to more people by lowering the monthly payment. The lower monthly payment was achieved not by making the house cheaper, but by extending the repayment period. Longer term, lower payment, vastly more total interest. The 30-year mortgage solved a real problem. People could qualify for homes they otherwise couldn't afford monthly. It created a different problem. It embedded an enormous premium into the cost of homeownership that is invisible in the monthly payment and only visible over the full lifetime of the loan. This is why comparing monthly payments is almost completely useless as a way to understand what you're agreeing to. Two mortgages with the same monthly payment can have drastically different total costs depending on their term, rate, and structure. The monthly payment is the most effective marketing number in real estate because it is the smallest plausible representation of a very large obligation. And most people, including people who consider themselves financially literate, evaluate their mortgage on the monthly payment and don't revisit it until they want to sell. The game changed decades before you played it. Nobody handed you a rulebook, they handed you a payment. Here is the paradigm shift that changes how you have to see this. Most people think of mortgage interest as a cost of home ownership, the same category as property taxes, maintenance, insurance, unavoidable. Fixed part of the price of having a home, it is not fixed. It is one of the most negotiable, most malleable, most within your control numbers in your entire financial life. Because unlike a tax rate or a maintenance emergency, the total interest you pay on your mortgage is almost entirely a function of one variable: time. Pay it off faster, you pay dramatically less. The math here is not incremental, it is not linear. It is geometric, and it moves in your favor with extraordinary efficiency once you understand it. Let me show you what this looks like in actual dollars, not in abstract principles. On a $400,000 mortgage at 6.5% for 30 years, your total interest paid over the life of the loan is roughly $511,000. You will pay more than twice the purchase price when you add principal and interest together. Now, add $250 a month to your principal payment. Not a dramatic number, not a life restructuring sacrifice. $250 more applied directly to principal every month. The loan pays off in 22 years instead of 30. You save approximately $160,000 in interest. $160,000 recaptured from the same house, the same purchase price, the same rate, just from redirecting $250 a month with a specific purpose. Nobody told you this was an option. Nobody explained at closing that extra principal payments are the highest guaranteed return available to a homeowner, that prepaying a 6.5% mortgage is equivalent to earning 6.5% risk-free, which no savings account in the world is currently offering you. The wealthy don't think about mortgages the way you were taught. They don't treat the amortization schedule as immutable. They treat it as a negotiation, one they have ongoing leverage in every single month, every time they make a payment. Here's the first principle that reshapes how you see this debt. Your mortgage is not a fixed obligation. It is the slowest possible version of paying off a house. And every month, you pay only the minimum as a month. The bank's share of your payment is maximized, and your equity growth is minimized. The common belief is that making the scheduled payment is responsible homeownership. It is. It is also the most expensive version of homeownership available to you. The minimum payment was designed by the lender for the lender's return on capital, not for your fastest path to owning the asset outright. The reframe: every dollar of extra principal payment is a dollar removed from a balance that is actively costing you 6, 7, 8% per year. It is the most direct, most guaranteed, most immediate financial improvement available to someone with a mortgage, before the stock market, before the investment account, before anything speculative. Paying off debt at a known rate is a known return. The identity shift is from homeowner who services a debt to homeowner who is actively acquiring an asset. Those are structurally the same action, both involve paying every month. They are psychologically and financially completely different. The second principle is one that takes longer to accept. Refinancing is not always a win, and the way most people think about refinancing, by looking at the monthly payment reduction, is almost perfectly designed to obscure the most important number. Here's what happens when you refinance 5 years into a 30-year mortgage into another 30-year mortgage. Even at a lower rate, You reset the clock. You go back to year one of the amortization schedule. The early years are, again, majority interest. The equity you built over 5 years of front-loaded interest payments is now the starting point for another 30 years of the same structure. The monthly payment might be lower. The total you pay over the life of both loans combined, old loan 5 years plus new loan 30 years, can be higher than if you'd simply continued with the original. Most people who refinance are shown the monthly payment before and after. They are rarely shown the total cost before and after, accounting for the reset of the amortization clock. Because the monthly payment number tells the story the lender needs told to close the refinance. This does not mean refinancing is always wrong. A meaningful rate reduction on a short remaining term can be genuinely advantageous. The question is simply whether you are evaluating it on the right number, and most people are not. Because they were never shown the right number to use, there is something darker underneath the entire structure of how mortgages are discussed in this country. The conversation around homeownership is saturated with the language of investment, equity, appreciation, building wealth. Your home is your greatest asset, and all of that is real to a degree. Home values, in most markets, over most long periods, do appreciate. But here is what the investment framing consistently omits. The return on your home equity is not calculated against what you paid for the house. It's calculated against what you actually invested, which includes every dollar of interest you paid to maintain. Ownership, while you built that equity, a house that was worth $300,000 when you bought it and is worth $500,000 when you sell it, did not return $200,000 of profit. From that $200,000, subtract the total interest paid over the loan, subtract maintenance and repairs, which over 30 years on any house will be substantial. Subtract transaction costs on both ends. Subtract property taxes compounded over decades. What you have left is your actual return. It is almost always smaller than people expect, sometimes significantly smaller. This is not an argument against buying a home. It is an argument against confusing the feeling of homeownership with the math of homeownership. The feeling is real, and it has real value that cannot be quantified. The math is also real, and it is almost never discussed at the table where you sign. 20 years from now, one of two things will have happened. Either you paid the minimum every month, the bank collected its front-loaded interest, and you'll own the house outright at the end of 30 years, having paid the original purchase price plus somewhere between 1 and 2 times that again in interest. And you'll have lived in a home, and that will have been worth something real and personal and hard to reduce to a number. Or at some point, maybe this year, maybe next, you looked at your amortization schedule for the first time. You found your outstanding balance. You calculated what even one extra payment per year would do to the total interest and the payoff date. And you made a decision with your eyes open. Not a dramatic one, not a life restructuring one, just a decision made from the real numbers rather than the monthly payment number. The people who make that second decision, who see the structure for what it is and make even small adjustments, will pay tens of thousands of dollars less for the same house. Not because they earn more, not because they found a loophole, because they understood the machine they were in and changed what was, in fact, changeable. So here is the choice as it actually stands. You can continue making the minimum payment, which is responsible, which is fine, which is what most homeowners do. The bank will profit well. You will own your home at the end of 30 years. Life will proceed. Or you can pull up your loan statement this week, not to feel bad about what you find, but to actually understand the structure you're inside. Find your current balance. Find your rate. Calculate what one extra payment a year would do. Calculate what $50 a month extra would do. Calculate what $250 would do. The numbers are not what most people expect. They are almost always dramatically better than most people expect, and knowing them is free. Acting on them costs $50 a month, or $100, or whatever the floor of your margin actually is. The bank designed this so that the default is their maximum return. The default doesn't have to be yours. What are you going to do with that?